Welcome to today's presentation. This is the road to homeownership, the how-tos and need-to-knows of buying your new home, presented by CommunityAmerica Credit Union. So what are we going to talk about today? Lots of different things, but to keep it simple, we're going to discuss everything you need to know from the day you decide you're ready to buy to the day you walk into your very own home. We'll talk about the three different stages in the home process. So before you begin your home search, we'll talk about budgeting for your new home, getting pre-approved, and choosing the right loan program for you. And then we'll talk about during your home search, so working with a realtor and going under contract. And then last but not least, we'll talk about finalizing the loan process. So what is processing and underwriting, and what's involved, and where do you go for closing? So before we go any further, you're probably wondering who I am and why I'm talking to you today. So let me share a few things about myself. I'm the manager of branch and outbound mortgage sales at CommunityAmerica Credit Union, and I've been in the mortgage industry with CommunityAmerica since 2014. I currently live in Overland Park with my husband Ben, our daughter Vivian, and our cat Oliver, and our dog Baxter. And yes, the cat and the dog do get along. And in my spare time when I'm not at work, I enjoy riding bikes with my family, puzzling, and decorating our home. So I'd like to take a quick moment to introduce Elise. Elise is monitoring our chat box today, so if you have any questions, please put those in the chat for us to answer. And now that you know a little bit about me, let's dive into the first step in the process, which is budgeting for your new home. When you begin to think about purchasing a home, always start by reviewing your current budget to find the right fit. Keep it simple and compare your monthly take-home pay with your current expenses. And ask yourself, how does it feel? Can you handle more, or you need to dial it back a little bit? Looking at your budget can seem so overwhelming, but CommunityAmerica has tons of free resources on budgeting and overall financial savviness. So be sure to check out our website and blog for these free tools. And keep in mind, your mortgage is more than just your mortgage payment. Sure, this is a huge part of homeownership, and that payment includes the principal and interest to the loan, your real estate taxes, your homeowner's insurance, and PMI, which is private mortgage insurance. And we'll dive into that topic here shortly. But there are other expenses to keep in mind. As a homeowner, you may incur homeowners association dues if you're buying in a community that has assessments, utilities for your new home. If your new home is going to be bigger than your current one, you can expect those expenses to go up. And then you'll have your general maintenance and care for the home, such as lawn care expenses, cleaning, and general upkeep expenses. Remember, as a homeowner, if something breaks, it's your responsibility to fix it. Try to draw a line in the sand and set a ceiling on your monthly housing budget, and don't go over it without careful consideration and knowing how that will affect your budget. Going over budget can dramatically affect your monthly obligations. In today's competitive market, many buyers are being asked to offer over asking price, so be sure you know how that impacts your payment. For example, going over budget by $30,000 can increase your payment by around $170 per month. And going over budget by $50,000 can increase your payment by close to $280 a month. So with that in mind, let's talk about the current housing market and what to expect. So what's going on out there? Right now, there are more buyers than sellers and houses on the market currently, so there's low inventory. And that's driving home prices up and lowering affordability. New construction homes are also more expensive due to supply chain disruptions and labor shortages. These have also extended the time frame for how long it takes to complete a new build. So what does that mean for you as a buyer? There's going to be a couple of key takeaways in today's presentation, and this is one of them. You must get pre-approved. Some agents are not accepting pre-qualifications anymore. So be sure you give yourself plenty of time to complete the pre-approval process, and don't reach out to your lender to start the same day you need to make an offer. And be sure you have all of your paperwork in order for your lender, and we'll go over some of those basic documentation requirements here shortly. Be sure you save as much as you possibly can. With some buyers having to offer way over asking price to get an offer accepted, you must be prepared to make up the appraisal gap. And be sure you find a local lender that agents trust and are easy to get a hold of when you are ready to make an offer. You, your agent, and lender should work together as a team to get you under contract. So first things first, there is a huge difference between a pre-qualification and a pre-approval. So we'll talk about those differences really quick. A pre-qualification is the first step in the process and requires the borrower submit a credit application. The application is then reviewed by the lender and run through automated processes for a simple yes, we would likely finance this borrower. A pre-approval is the next step after pre-qualification. The borrower has gone through the pre-qualification and has already submitted all the necessary documents to the lender for a more specific yes, we will finance this person under these specific conditions. In essence, a pre-approval is like completing every possible step before you find the house. For the pre-approval, your lender will ask you for all your supporting documents to verify your income, your assets, and credit. So be prepared to supply the following at minimum: your last 30 days pay stubs and last 2 years tax returns and W-2s, your last 60 days bank and investment account statements, and any explanations of recent credit inquiries on your credit. So why do we encourage borrowers to complete this pre-approval step? A pre-approval is a much stronger offer, and with the way the market is now, it's almost a requirement for getting under contract. I try to stay in touch with my personal agent as often as I can, and I hear from tons of other agents out there that we work with on a daily basis. And right now, agents are tossing out pre-qualifications. So do yourself a favor and get pre-approved. So how do you go about the process of getting approved? You'll want to contact your CommunityAmerica mortgage advisor, and you can do so by stopping in at your closest branch, applying online, or you can call us at 913-905-6887. We will walk through the initial credit application with you, determine how much you can be pre-approved for, and talk about what loan options are available for you and best fit your needs. And no matter where you go for your mortgage, keep a few things in mind when choosing your lender and mortgage advisor. They should be someone who listens to your financial goals and can present different options that will help you achieve those. They should be someone who is readily available and accessible and who listens and answers your questions. They should also be someone you like as a person. You're going to be working with them a lot, so be sure you have a good working relationship. And they should be someone who can offer benefits with your mortgage. When you get your pre-approval, your advisor should provide you with a pre-approval letter and estimates for monthly payment, your closing costs, and your prepaids. So basically, your total estimated out-of-pocket expense for your purchase. So how do you and your mortgage advisor go about choosing the right loan for you? We're going to dive into that next. Finding the best mortgage program for your specific situation will give you the most buying power. There are lots of different mortgage programs to consider, and you need to know your specific situation to decide which is the best for you. When determining which is the best fit for you, there are three main factors to consider: your credit, your income, and your assets. So let's consider how these can affect your ability to qualify, starting with your credit. Simply put, the higher your credit score, the more loan options you will have available to you. For reference, CommunityAmerica and most other lenders will require a minimum credit score of 620. But to really optimize your buying power, you will want to shoot for 700 or higher on that credit. So if you aren't there yet, how can you crank your credit into overdrive? There are 5 primary scoring components to think about. The first is your payment history, and this is the most important. Make sure you are making your payments in full and on time. The second component is your amounts owed. Try to keep your revolving accounts, like credit cards, below a third of their credit limit. For example, if you have a $10,000 credit limit on a card, keep your balance below $3,000. The third factor is the length of your credit history. if you are just starting out, there's not much you can do here but wait. Like a fine wine, it just gets better with age. But if you have established credit, try not to cancel any of your revolving accounts, even if you aren't using them on a daily basis. Doing so will detract from your length of history and can have a negative impact on your credit. The fourth is having a healthy mix of credit. If you have both installment and revolving credit, that's a good thing. And then the last component is establishing new credit. Avoid opening new credit unless you actually need it. Opening new credit can negatively impact your credit scores until you have an established payment history on the new account. Keep in mind, it just takes time to change your credit, so be patient. And like I mentioned before with budgeting, CommunityAmerica has lots of free resources on building and improving your credit. You can always find information on our website or just stop by a branch and talk to someone. We're happy to help. You can also pull a free copy of your credit report once every year at annualcreditreport.com, and Elise will share that link in the chat function for you. So let's turn our attention to the next factor a lender considers when making their credit decision, and that's a borrower's income. There are 3 factors your lender is going to look at when reviewing your income. Is it stable? Is it consistent? And is it likely to continue? So what do we mean by all those things? For an income to be considered stable, we must document that you are going to be able to repay your loan. Typically, 2 years of employment history is going to be required. However, a borrower may be able to get away with a shorter history if you can show post-secondary training in that time, like college or trade schooling. For an income to be considered consistent, we must show the frequency of a borrower's pay and their pay rate. The simplest way to get mortgage approval is going to be with a salaried position or a guaranteed 40 hours a week job. Variable income or hourly income is reviewed differently and will require a 2-year history regardless of any education in that time. This would include self-employment, commission, or tip-driven positions. For a lender to consider an income's continuance, we must consider factors such as a borrower's changing careers or experiencing a loss in income. Either can dramatically affect your ability to qualify for a loan, so be sure to consult with your mortgage advisor as soon as possible if you are considering any career changes during the process. And last but not least, let's talk about that third qualifier, your assets. And this is another key takeaway. There's a common misconception out there that you must have 20% down payment to purchase a home, and in most cases, that's simply not true. Depending on what loan programs you qualify for, you can expect 0 to 5% as the minimum range for down payment. And there are really 2 things to think about when you are evaluating your assets needed to buy a home, and those are your down payment and your closing costs. Your down payment is money that goes towards the cost of the home. Lenders like to see down payment because it puts skin in the game for you and gives you a little bit of equity going into that purchase. There are some rules around where this money can come from. Acceptable sources for down payment are money in your checking or savings account, investment accounts, and gifts from family members. Unacceptable sources for this money would be things like physical cash on hand, unsecured loans or credit cards, and payday loans. In addition to any down payment required, you will also need to plan for your closing costs. These are the costs of purchasing and financing a home outside of the price of the home itself, and these costs can be broken down into 2 sections. First, you have your loan costs, which include the cost of obtaining financing. So these fees include lender fees and all of your third-party fees for services rendered to get the loan, such as your appraisal fee, your title fees, and credit report fees. Then you also have your prepaid costs. Prepaids are upfront taxes and insurance paid at closing. Typically, a buyer will prepay their first year's homeowner's insurance plus establish their escrow account. These are costs any homeowner would have. You just have to prepay a portion of these at closing. Sometimes your lender or the seller will help cover a portion of these costs, so make sure you talk to your realtor and lender about what options exist. Now that we've reviewed the 3 main qualifiers, let's talk about the types of loans you will see in the market. Once your lender has evaluated your position with your credit, income, and assets, you should work with your lender to discuss the best type of loan program for you. And there are lots of loan options out there. We're just going to talk about some of the most common ones that you'll see. And perhaps the most common one that you'll hear about is the conventional loan. This mortgage will typically have a low 3 to 5% down payment option and more competitive interest rates and private mortgage insurance premiums for borrowers with higher credit scores than an FHA loan. You will see both fixed and adjustable rate options and terms anywhere from 10 to 30 years, although most people tend to choose a 15 or 30-year fixed. And while these loans do typically require private mortgage insurance, that expense will drop off once you pay a certain amount of principal off. These loans are a great option for borrowers with good credit who are willing to make a decent down payment in exchange for better rates. And since I mentioned PMI, you might be wondering what that is, so let's review that quickly. PMI stands for private mortgage insurance. You'll hear private mortgage insurance or PMI talked about in many different loan scenarios. PMI is insurance that the secondary market will require borrowers to pay to protect the lender if you stop paying your loan. This is different than your homeowner's insurance, and it's important to remember that it may be required until you reach a certain level of equity in your home. It's important to keep this in mind when you are thinking about your budget, and your lender should include this cost in your pre-approval estimate if it's applicable to your situation. So there are a few other types of common loan programs that you'll see out there, and we'll touch base on the FHA loan first. The FHA loan also has a very low down payment requirement of 3.5%, and this loan typically provides more competitive interest rates and PMI premiums for borrowers with lower credit scores compared to conventional loans. These loans are geared towards borrowers who may not have as much credit history established. They may have more debt on credit or less than perfect credit. Similar to conventional loans, these will require PMI, but it typically will not drop off at any point. You'll also hear about VA loans, and VA loans are available to qualified veterans and current service members and requires no down payment. 0% down payment allows borrowers to purchase a home with little to no money due at closing. And there's no PMI required, which can help make the payments more affordable and offer veterans increased spending power. As a plus, this is a lifetime veterans benefit that can be used multiple times. And last but not least, I would like to mention our CommunityAmerica First-Time Home Buyers Loan, which is a unique product to the credit union. This is a loan product specifically created to allow first-time home buyers to keep more of their savings in the bank instead of having to put it into a down payment. There's 0% down payment required, but you must apply $500 of your own funds towards the closing costs. There are a few additional requirements that must be met, so talk to your mortgage advisor at CommunityAmerica if you think you might be interested in this loan. And now I'd like to pause and see if we have any questions in the chat.
We do. We have lots of questions in the chat, actually, Jackie.
Wonderful.
First, I'm a little out of order, but I'm gonna try and make it make sense. Julie would like to know how many months worth of bank statements should we plan on preparing?
That's a great question, Julie. At least 60 days. If you are purchasing a new construction home, you may have to go back further than that. And we'll get a little bit into this topic after the questions, but on new construction homes, because it takes longer for that new build to be completed, you're still going to be required to put some earnest money down at the time that you sign the contract. You're going to have to provide those bank statements to show that money coming out of your account. But typically for most scenarios, you're looking at 60 days. Make sure you have all pages, even if there are blank pages in that statement.
Great. The next question, Lisa would like to know, is the pre-approval for a specific house, or do you get the pre-approval before you go on your house hunt?
That's a great question. It's not specific to any home. You would use the pre-approval letter for whenever you're ready to make an offer. So, and that's something that we can customize for your offer. So it's not uncommon for a borrower to start out at a certain price point and then find that they need to adjust that as they continue their search. So it's not necessarily set in stone at the time that we complete the pre-approval. We can always make changes.
Great. Follow up, how long is that pre-approval good for?
Good question. Typically, the pre-approval is good for about 30 days. That's because all of your income documentation technically expires after 30 days, but your pre-qualification and your credit report are good for 120. So if you ever needed to re-up that pre-approval, it would be very simple. We would just have to get updated pay stubs, perhaps a bank statement or two, and we can get that pre-approval updated for you.
Okay. How long does it take to get to the closing point after you've been pre-approved?
That's also a great question, and that's different for every buyer. Some buyers go under contract like right away after completing the pre-approval process, and some buyers take months to go under contract. So it just really depends on you as the buyer when you go under contract. So, but what I will say is from once you go under contract to closing, typically that process is about 30 days. However, we can do it in a shorter time frame if you need to.
We have lots of questions coming in, so we might not have a chance to get to all of them, but if we don't answer your question right now, I'll make sure that we follow up with a specific answer. But we can probably do maybe a couple more. Jason would like to know, can an existing home be used as your down payment? As in you would sell your home, sell your current home and buy a new one. How does that work?
Yes, so there's a couple of options out there if you wanted to use your current home as collateral. We do offer a bridge loan product where you can use that equity and draw that equity out of your existing home in the form of a bridge loan. And then we do see a lot of borrowers where they have an existing home equity line of credit on their existing home. We do see a lot of buyers take advantage of that line of credit to draw that equity out for the down payment on the new house.
I think we have one more. Will the pre-approval require a hard check on your credit? For a credit check, will it go, will it hurt credit if it takes more than 120 days to find the perfect home?
Yeah, that's an awesome question. It would be a hard check on your credit, and we pull from all 3 credit bureaus. That credit report is good for 120 days. If you are still shopping outside that window, we're not going to automatically pull your credit before touching base with you to see where you're at in the process. So ideally, we'd want to time out that second credit pull once you're closer to finding that house or getting ready to make that offer, because we want to protect your credit as much as we possibly can, and we don't want to pull it too many times because, yes, that can draw your credit scores down a little bit. All right. So like Lee said, we'll take more questions at the end, but we'll keep going. So now that you have done all of the prep work and you know your budget, what programs you qualify for, and you have your pre-approval letter in hand, it's time to find a realtor and go house hunting. And personally, this is my favorite part of the process. I love looking at homes. So we always recommend that you work with a real estate agent. Your realtor will set you up on a home search, attend showings with you, and be your advocate in the negotiation process. When you're ready to make an offer, they will search for comparable sold prices of similar homes in the market to assist in determining the best offering price. They will also coordinate with inspectors, appraisers, the title company, and your lender to ensure that all parties are on the same page, all the necessary documents are signed and terms are met, and that no last-minute issues pop up. So how do you find a real estate agent? We recommend that you ask your friends, family, and neighbors for recommendations. Be sure to check reviews, testimonials, and references, but know that your lender can also provide recommendations. CommunityAmerica works with thousands of realtors every year, and we are more than happy to make a good recommendation should you need one. This probably goes without saying, but you will spend a lot of face-to-face time with your realtor, so make sure you also have a good working relationship with them. So next, I'd like to talk about what happens when you find the right house and you're under contract. So the process really picks up from here, and there are lots of things on your to-do list. First, you will provide the contract to your mortgage advisor, finalize the loan setup, and discuss locking in your interest rate. Your mortgage advisor will send you an initial loan disclosure packet, including the official loan estimate, which covers all the specific details of your loan in an itemized format. Your lender will also ask you to provide supporting income, asset, and credit documents if you haven't done so already, or they may require updates to this documentation if you supplied these for the pre-approval. Initial information requests will try to gather as much information as possible, but please be prepared to provide additional or updated documents that may be requested. Additionally, you will also work with your realtor to order home inspections and deliver your earnest money to the title company. So let's talk about those two things real quick. Your earnest money is an upfront deposit paid to the seller's title company as a sign of good faith that you do intend to move forward with the purchase of the home. This money is held in escrow and will be applied towards your down payment or closing costs at closing. And then you'll want to make sure that you order your home inspections. And the costs for these range anywhere from $300 to $500, depending on the inspector and the scope of the work. It is important to note that there is a difference between the home inspections and the appraisal. The home inspector is there to check on the bones of the home. So they're looking at the structure, the roof, the plumbing, etc. And your lender will order your appraisal on your behalf. So different from your inspection, the appraisal is an opinion of the value of your new home. Both of these are an out-of-pocket expense paid prior to closing. And again, your general home inspection should be anywhere from $300 to $500, and your appraisal should be around $500 on average. At this point, you will also begin to shop for your homeowner's insurance. This is different than PMI and provides protection on the house itself. Your lender will require that this policy be in place before closing, so it's important to start shopping soon after getting under contract. And don't forget that you get to choose your insurance provider for this. CommunityAmerica does offer a full line of insurance services, so be sure to check us out. After you've supplied all your paperwork to your lender, the next step in the process is to go through loan processing and underwriting. And this is a fancy way of saying your lender is getting everything organized to approve and fund your loan. They are crossing all their T's and dotting all their I's to make sure that they are comfortable providing this amount of money to this borrower for this house. The lender will review all of your documents and may ask for additional details to clarify the documents you provided. This is very normal and part of the process. Additionally, your loan processor is working behind the scenes to order your title work and set up your escrow account, which is where your insurance and taxes will be paid from. Once the lender has reviewed and clarified any conditions in your documents, you will get the final approval. So what happens after that? We're going to talk about closing here. So once your loan is officially approved, your lender will begin working with the title company to start balancing the transaction and set up a closing. I've mentioned the title company several times, but let's clarify what the title company does in this transaction. They do two things. First, the title company is responsible for making sure the property can legally change hands. They investigate any liens on the property or other issues that may impact the seller's ability to sell the property and your ability to take clear title. Second, the title company facilitates the sale of the property. As a neutral third party in the transaction, all the money flows through the title company. About a week prior to your closing, your mortgage advisor will send you a preliminary closing disclosure as a preview to the final closing disclosure you will receive a day or two prior to your closing day. Upon receipt of your final closing disclosure, your final closing amount can be paid by cashier's check or wire transfer. Don't forget, this money will go to the title company, so your cashier's check will need to be payable to it. And then let's talk about the actual day of closing. So you made it. You and your realtor are going to go to the title company and sign your documents there. Be sure that you bring a government-issued ID and your funds to close. There, you're going to review the documents for accuracy and sign with the notary. And after you sign and hand over your funds for closing, the title company will submit your signed lender documents back to the lender, who will review to make sure they have all the necessary paperwork to authorize funding. This may take a few hours, so be patient, but funding takes place same day so that you can take possession. And then don't forget a keychain, because after funding, the house is yours. Right. And then I would like to mention some of the benefits that we offer with CommunityAmerica and our mortgage product. We kind of touched upon this earlier when we were talking about how to choose a local lender. So I wanted to highlight some of those things. We do offer local originations, processing, underwriting, and closing. And we also have local servicing through True Home Solutions, which is a subsidiary of CommunityAmerica. So if you're a current member with us or looking to become a member with us, one of the most convenient things about having your mortgage with a credit union is that you can pay your mortgage through your online banking. We also offer no prepayment penalties, we have competitive rates and fees, and we have lots of different loan programs to find the best fit for your situation. And then last but certainly not least, we offer profit payouts. This year we paid $9 million back to our members, and members with a CommunityAmerica mortgage typically see the most money back. Plus, don't forget, for attending today's presentation, you qualify to receive $500 off your closing costs. You will receive an email following the presentation today with details of the offer. Just be sure to show your mortgage advisor the email and let them know you attended today when you start the process. And I'd like to turn it over now for more questions.
Yes. We have lots more questions. So again, we will try to get through all of them. And if we don't answer your question right now, we will definitely connect with you afterwards and get you the answer. We kind of talked about this, but are appraisals required for the buyer to get approval? And the seller does pay for the appraisal, correct?
That's a great question. It depends on your loan program. So all government loans like FHA and VA, they will require an appraisal no matter what. The conventional loan program depends on the property itself and your credit situation and how much down payment you're putting down. So once you go under contract, your lender would input the address of the home into your file. You would finalize the loan setup. So we would go over, how much are you putting down in down payment? What term are you doing? And then we would run that back through automated underwriting through Fannie Mae or Freddie Mac. And those underwriting engines would tell us whether or not we are required to do an appraisal. Typically, this is an out-of-pocket expense for the buyer. I've probably seen it a handful of times where the seller pays for it, but that would have to be negotiated into the contract.
With the current state of the economy, Jackie, what's your outlook on adjustable rate mortgages?
Oh, that's a great question. They've become a more popular option in the last few months. If you've been following fixed rate loans, you've probably noticed that fixed rate mortgages have gone up quite a bit in rate. I think it's a good option for many buyers, but it's really going to depend on your specific situation. For first-time home buyers, a lot of first-timers will maybe stay in their first home for 5 years or so. So it might be a good option for you as a first-timer. Many adjustable rate mortgages have initial fixed term of 5, 7, and 10 years with an amortization over 30 years. So if you know it's going to be a short-term home for you, it's not your forever home, it might be a good option for you. And hopefully in the next few years, we'll see fixed-rate mortgages come back down. But it is definitely a good option to have a more affordable payment right now.
For closing costs, can you choose not to use the escrow and pay for taxes and insurance directly on your own?
In some cases, yes. All government loans like FHA and VA will require that, so there's not the option to waive escrow. But on conventional loan programs, you sometimes can. It just really depends on the lender's requirement. So normally we would submit that to senior management for the approval to waive escrow. And like I said, all lenders have different requirements on that, so you'd want to check with your specific lender. And if you're going with CommunityAmerica, you can check with your advisor and they'll walk you through that.
Can you talk about rate locks, the pros and cons of locking in your rate, and how, if CommunityAmerica offers a rate lock?
Yeah. So we are working on a lock and shop program. We don't currently have that out right now, but we will soon. So more details to come on that. But currently you can lock in your rate once you go under contract. We need to have the specific details of the home, the subject property address, your closing date, all that good stuff so that we know the appropriate lock term to lock you in on. If you're buying new construction, once you go under contract, we can look at an extended lock for new construction homes because those typically take about 9 to 12 months to complete. And I do recommend locking in your rate as soon as possible in this environment because rates they can fluctuate from day to day, and they have been going up last few months. So I would definitely recommend locking in as soon as you can.
Great. We have another one who asked about splitting monthly payments into bi-weekly. So you pay 13 payments instead of 12. Is this an option? And who would you contact if you wanted to do that?
Yeah, that's a great question. We do offer biweekly payments. You would need to contact our servicing department, True Home Solutions, after closing to get that set up, but it's quick and easy, and they'll get that squared away for you. So,
can you talk about the general requirements for CommunityAmerica loans, mortgages?
Well, we do offer a lot of different loan programs, like we mentioned before, so it really depends on your specific situation and what programs you qualify for, but generally speaking, we need at least a 620 credit score or above. And there's a term called debt to income ratio. So that's one thing that we look at is how much debt do you have on a monthly basis compared to your gross monthly income. So for a lot of loan programs, that needs to be under 43%. But with some government loans like FHA and VA, you can sometimes go higher than that. So it really just depends on the loan program and your specific situation. But 620 or above on the credit, 0 to 5%, again, 0 to 5% down payment depending on which loan program you're going for, and 43% or under on the debt to income ratio.
We'll do a couple more. Again, we've got lots coming in, guys. Those are great. So, can CommunityAmerica do a mortgage if we purchase a home in a state other than Kansas or Missouri?
We can. That's an awesome question. We're not licensed in all 50 states, but we're in most of them. So just give us a call or stop in at the branch and talk to the mortgage advisor there, and we can guide you on that.
Can you talk about the pros and cons of buying a lot or a mobile home instead of an existing home?
Gotcha. So a lot would be for like land, I'm assuming.
I think that's what we mean.
Okay. Yeah, so we don't offer land loans currently, but if you're looking to construct a new home on that lot, we do have a construction to permanent loan where you can sometimes wrap in that purchase of the lot into that construction loan. So that's really specific if you're looking to build on that house. In terms of mobile homes, or what we call manufactured homes, a couple things that you'd want to consider when you're looking at those homes. Most lenders are going to require that a manufactured home be a double wide. So you're not going to find many lenders out there that will lend on a single wide. The manufactured home must also be on a permanent foundation, so you won't be able to move it. There are also higher interest rates and typically larger down payments associated with manufactured homes. They're seen as a little bit riskier of a loan for lenders. So keep that in mind. If you are looking to buy a manufactured home, you'd want to specify that with your mortgage advisor up front, because that can change the terms once you go under contract if they're not aware that you're looking at that.
Okay, I think we're going to be able to get a couple more in here. Can you talk about mortgage options and how it works when there's more than one person on the mortgage if they are not married in particular?
Yeah.
A little more specific of those questions. How do you base the income and credit scores? Is it based on both of them or separately?
Okay.
Those sorts of things.
Yeah, that's a great question. So whenever you have multiple borrowers on the loan, we look at the lower middle credit score as between the two borrowers as the qualifying credit score on the application. So the lower middle credit score between the two borrowers there. We would take into consideration the gross income as long as both borrowers had qualifying income. So as an example, if you had one borrower with a salary position but the other was self-employed and they were self-employed for less than 2 years, we may not be able to consider the self-employed income on the application because of the time frame there. But in most cases, if you're a salary position or hourly full-time, we can consider both.
Great, and I think I can wrap a couple questions into one for this last. Can you talk about a mortgage option that would work if you are buying a house that needs repairs or potentially want to build onto an existing home with additional space?
Ooh, that's a good one. Yeah, so that is probably going to require a special loan down the road. As long as the home is move-in ready, and by that I mean as long as it has all the major components. There aren't walls missing, bathrooms missing. As long as it's move-in ready, even if there's cosmetic things that you want to change, we can still do a loan on the property. Once you're in the property, though, you might want to consider looking at a home equity loan or line of credit to assist with that renovation. And there are other types of loans out there in the market that you can do, like a purchase to renovation mortgage, which is something that we're looking at possibly adding to our portfolio as well. But there are loans out there like that too. So that's a good question.
We are right at the end of time. Do you want to take one more?
Sure.
I think, again, I can combine a few. Can you talk about how long you would want to keep a mortgage or how much you would need to pay off your mortgage before you think about refinancing?
You're going to want to have at least 5% equity in the home, if not more. When refinancing, we want to make sure there's a benefit to you to refinance. We don't want to refinance you just for the sake of refinancing you. So we want there to be some sort of benefit. So at least 5% equity, if not more. A lot of times people refinance to remove the PMI. So if you're looking to do that, you'd want to have at least 20% equity or more. We'd also want there to be some sort of rate benefit, or you're possibly changing terms to pay off the loan sooner, like moving from a 30 to a 15. And then you also have other borrowers that refinance for debt consolidation. So that could be an option that we would look at for you in the future if it made sense to consolidate debt as long as you had the equity. And it makes sense from like a monthly cash flow standpoint and interest rate standpoint. Every borrower's situation is different. So, again, we encourage you to give us a call so we can talk through your specific situation. But those are the few things that come to my mind immediately. All right. Well, that's all the time that we have for today. So thank you so much for sticking with us to the end. And we look forward to hearing from you soon. So have a great day, everyone.